Hello, I'm Adam Day, Managing Director of the Farmer Networks of Cumbria, Northumberland and the Yorkshire Dales. We're a not-for-profit organisation that tries to support farmers whatever challenges they may face and to look at whatever opportunities might be out there in future. We've had a lot of chats in recent weeks with concerned farmers following the recent budget and the proposed changes to inheritance tax rules. And as a result, we've been running some meetings and events to try and cut through all of this information and make sure that our farmers understand what it means and potential solutions and actions that may take place in the future. This week we had an online webinar event with Armstrong, Watson Accountants and Sinton's Solicitors from Newcastle, looking at the proposed changes and talking about succession issues and possible actions. For those farmers who still have some questions or some worries about the proposed changes, we hope this recording of our webinar held this week will help. And if you need any further information, please do pick up the phone and call the Farmer Network. Our head office number is 01768 868 615. We're always here to help, whatever the challenge, whatever the opportunity. I hope our webinar is of help. So, over to you, Andrew Robinson. You first on the stand.
Thank you, Adam. Good evening, everyone that's watching. I'll just try and make this technology work and share my slides and not my emails. That'd be a good start, wouldn't it? So hopefully everyone watching can see that. So I'm going to go through the content of the night is succession planning, which has been thrown into total disarray by the budget 24. So we'll work our way through that. There's just as Adam was saying, I've got a foot in both camps of this. I've got a accountant's head on as an expert in inheritance tax and capital gains tax and many other things, and I've got a foot in the farming camp where it affects us like everyone else, and I'm constantly snapping pictures in the summer, winter months. So I thought, if we're talking about succession and the impact of the budget, those were the subjects that I'll go through, a bit of where we're at now, the headlines from the budget, and then a bit more detail around things that will affect all farming businesses to some extent over the next few years. So if you're looking at succession, or you're looking at just trying to put solutions in place against the new proposed inheritance tax legislation, whatever you're doing, but especially for succession, you've got to know what you've got. There's no point worrying about inheritance tax if you don't know what you've already got. Now, that might seem a bit of a glib and a weird thing, but there's 4 things on there. So, do you know who owns what in your business? Do you understand your accounts? Do you have a partnership agreement? And does everyone have a will? Now, I know we have Tom and Sam who will have their own legal opinions and possibly comment a little bit on partnership agreements, but it seems very, of course, you know who owns what, but you might think that because mum and dad are on the title deeds of the farm property, that it's owned by them. But if it's shown in the partnership accounts and the partnership agreement doesn't reference it, it could actually be owned by all 3 partners or 4 partners, however many you've got. So it's key, even before this legislation, that you understand what you've got and not just assume who owns it. Do you understand your accounts? Yes, I'm sure you understand your accounts and they show a profit or a loss, but hopefully a profit, and you've got to pay tax. But do you understand who owns the capital in the business? Because all that is now going to be potentially exposed to inheritance tax now they've lowered the limits. And do you know the impact of moving that capital about and things? Many farming businesses, even though we've chirped on at them, and I'm sure Sam and Tom have as well, to get a partnership agreement, still haven't. I think it's going to be an absolute necessity that even a family farming business of parents and sons and daughters will have to have a partnership agreement that clearly sets out who owns what. If it's set out right, it could be one of the helping solutions to reduce exposure to inheritance tax. So if you haven't got one, you will have to have one, I'm afraid, and it will help protect you, so it'll be very worthwhile. And then, does everyone have a will? And I'm sure Tom would agree with it is scarily surprising how many farmers still don't have a valid will. You always should have had a will. Everyone should have a will. But again, it's going to become even more important on some of the things in it. So you can't start and plan for the future and succession and inheritance tax if you don't know that. I always preach on, as Adam probably knows, that you need to know what bit of your business is making profit, what bit isn't, what expenditure on new machinery, what your stock levels are, and all these sort of things. They become relevant to be able to manage your business and allow you to adapt your business for the next generation. But also, all the assets are now going to be at risk of inheritance tax, as I'll explain later. And I suppose to make any decisions going forward and changes you may or may not make for inheritance tax or capital gains tax, you need to know what impact it'll have on your cash flow. You need to know the business decisions you change will they into what impact will they have on profitability, margins, etc. So what I'm encouraging you here is an absolute necessity before you start worrying too much about the inheritance tax and succession. Understand exactly what you've got. So budget. I think from my point of view, the budget's far more draconian than I ever expected, or me and our colleagues expected. I think the warning signs were clearly shown when Rachel Reeves and Keir Starmer took the fuel allowance off every pensioner in the country. It was quite an eye-opener. But it's definitely more draconian than any of us expected. So the budget headlines that will affect any business, to be fair, most of them, but farming businesses is what we're referring to this evening. We'll come back to inheritance tax because it was a bombshell. Capital gains tax, anything sold on or after the 30th of October 24, i.e. the day of the budget, has now had a 4% increase. So you'll pay 24 rather than 20. If you sell all of your business and qualify for business asset disposal relief, each owner of the business will still get £1 million of relief against the sale of the whole of a business. But that relief used to reduce it to an effective rate of 10% tax. Now, if you can get the relief, it'll only reduce it to a 14% rate of tax. And then in 2 years' time, it'll only reduce it to an 18% tax. So if part of your succession planning and result of the budget is I've had enough, I'm going to sell it, there is some tax increases there to consider. Many farmers have employees. Many businesses have employees, obviously. In the sector we have, the processors that buy all our products in farming have vast numbers of employees. So the national insurance increase is going to have a major impact on the food and farming sector, as well as every other business. Just something you need to factor into your budgets when you're doing them on the farm. Double cab pickups, a nuisance, that's disappointing, but anything like as dramatic as the tax. But effectively, from any double cab pickups bought from the 6th of April 2026 will now be classed as a car rather than a van for tax purposes, meaning the allowances you can claim on them are much restricted. So I think the garages will do a roaring trade in double cab pickups as long as they can deliver them before the end of March. And then the one that frustrates me the most, because it's got brushed nicely under the carpet and buried by inheritance tax, is that next September there will be the maximum basic payment you will be able to receive after they've capped it will be £7,200. So in 10 months' time, that will have a significant effect on budgets and cash flows. And Adam's better placed to do it. But when I spoke to Daniel Zeichner at a recent conference and challenged him why he'd taken it off, his answer was to put in the environmental and SFI schemes. But since then, they've all been restricted or shut, or you can't get in them. So skeptical is definitely one way for it. But that's something we all have to factor in. So inheritance tax, in no particular order. Planning is now absolutely essential, or will be essential. Why do I say will? I would, and I'm sure my colleagues on this webinar would agree, nobody should be doing anything at the moment. What do I mean by that? Not making the changes. Everyone should be doing research of their assets, getting all the facts together, getting the partnership agreements, the wills, estimated valuations, gather the information, have initial chats, but please don't go out and do legally binding transfers and gifts and whatever else you might do, because we haven't seen the detail behind this yet. This may not be law till next April. So just keep calm and plan. But for it, so where are we at? What are the changes? Well, as you all know, up until the budget, and in fact still today, basically agricultural property relief covered the full value of your farm unlimitless, and business property relief covered the full value of the business. And in farming, what we mean by that is the cows, the sheep, the parlour, the tractor, the combine, the hens, the sheep, whatever. They were both just readily available. And if you just had a routine farm without diversifications and all that sort of thing, you got inheritance tax was not to worry about. And this is probably one of the reasons why a lot of land is still held in older generations and succession hasn't been thought about or pushed on more. But from the 6th of April 2026, each individual will only get £1 million of agricultural and business property relief combined. So I must make that clear that it isn't $1 million for the agricultural property relief and $1 million for business property relief. It is $1 million combined. So if your farm and business, and I've got an example in a minute, is worth $3 million and it's owned jointly husband and wife, you'll get $2 million cover on agriculture and business property relief, $1 million each, and the $1 million over that, subject to a lot of other calculations and personal assets and things, will be taxed at 40% tax, but reduced by 50%. So you'll pay 20% tax. So you can clearly see, we'll not get into the debate tonight what constitutes a family farm. We all know they've got the wrong figures, the wrong stats, the wrong data. That has meant they've got these allowances too low. But so it's a dramatic change that there was unlimited cover from the 6th of April. Anyone will only get 6th of April 26. You get £1 million each. All other IHT rates and reliefs and limits for gifts, 7-year rules are the same. There was no changes to them. One bonus or one clarification that was worthwhile is they did confirm that land in environmental schemes of any sort qualify for agricultural property relief, so they can be covered by your $1 million. There have been some debates and consultations whether long-term environmental schemes actually was farming for tax purposes. And as I've reminded people many things, don't think because you've got a farm, you've got a farm. If it's got let properties and diversifications and non-agricultural value, you still need to be very wary of them. And in fact, more wary, because we've all got to remember through this, even if we do our planning, HMRC is going to be much more interested in farmers' estates when they pass away, because there's potential tax for HMRC now where there never was. So we're all going to have to get our ducks in a row. So what are some of the mitigation techniques? And I'm not going to go through these detail or with reference to particular assets, because I know Tom and Sam are very much going to look at land and how it can be mitigated. But obviously, you can still give assets away business assets, so farm assets, tax-free to connected family members and next generations, free of capital gains tax. So they can still be made free of capital gains tax. And if you survive them 7 years, that has gone from your estate. So there's going to be a lot of that to do. Even if you don't survive the 7 years, after the year 3, the tax does start to reduce, is tapered. Some things to watch out for: that if you give the asset away and you want it to be given away for inheritance tax purposes, you can't still benefit from it. So very simply, benefiting from it is continuing to live in a house you've given away. You would still benefit from it. Still earning an income. So if you've given all the farmland away and you're still taking a big chunky profit share from the partnership or the farm business ran on that land, you're still benefiting on it. And essentially it falls into gift with reservation of benefit legislation that says, that's fine, you've legally given it away, but we still want it in your estate for inheritance tax. So there's going to have to, we are going to have to dot these I's and cross the T's. Trusts, I think, will become a useful part in planning. They aren't the be all and end all. And lawyers are probably better at, or Sam and Tom's colleagues are probably better at wills than any of us on here, but I know there's even less detail out about them at the moment. And then life assurance will give peace of mind and will be necessary, I think. So I'm not referring to taking life assurance on 70-year-old dad who's gifting the farm to son, because that would be massively expensive to cover a person of that age. But if son's 40, it would make a lot of sense to take some life assurance to cover the inheritance tax should anything unexpected, tragic, or whatever happens to the son when they own it, because obviously you haven't done any planning. The other thing I should have just said before I turned the screen, one thing to bear in mind, the £1 million is per person, per owner of your business. So I think we will probably, another solution may to involve more people in the business, i.e. the young generations, but it's not transferable. So if us male farmers are all going to pass away before our wives statistically, so if the husband has his will and leaves everything to his surviving spouse, there'll be no inheritance tax paid on husband's death because it's all gone tax-free to spouse, but his £1 million allowance on the farm has been wasted. The £1 million does not transfer with the estate to the spouse. So I think when we get the details out, and I'm sure Sam and Tom will agree, every elder generation is going to want to get rid of all the farm so they don't have anything to give away in their will, or they will need to give £1 million away, otherwise they're wasting their £1 million allowance. So I think there's some thoughts around that. Just some quick examples just to show you. So this is as of today, that we have a widowed farmer, who's in partnership with his son, but the farm's all still owned by father. Farmer 3.5 million, but partnership capital, i.e. tractors, sheep, cows, $500,000, and then some personal assets, non-farming. So as you can see, the current inheritance tax position is that there is no inheritance tax, because the total assets are 4.3, 4 million of them are covered by APR, BPR, so the farm APR, partnership capital BPR, pardon me. So there's 300,000 left chargeable, but every individual in the country gets the 325. So that covers his personal assets, so no inheritance tax. And if the farm had been worth 40 million and he'd farmed it all in hand, there would have still been no tax on those equations. The numbers are a little bit smaller and maybe buried under the thing, but so if this is, if that farmer does nothing, buries his head in the sand, we may call it, and passes away after April 26, you can see this is a rather nasty. So he does nothing, he just buries his head in the sand and says, that's fine, I'll just leave it to my son in the will. There would be £590,000 of inheritance tax to pay on that example. And why is that? Because the 4 million of farmland and partnership capital now only gets £1 million of cover. So you've got £3 million worth of farm effectively getting taxed at 20%. So obviously sitting and burying the head in the sand when detail comes out is of no use and quite a scary prospect. So I know Tom and Sam will talk more on this. So if he was to gift the farm to his son as soon as we have the detail, he has to survive the 7 years to get away from it. He couldn't take an income from that bit of the farm, but you can see that even after years 4, the number starts to drop. And by year 7, it's gone. So with some careful planning, maybe some use of company structures and all sorts of things when the deal's out, it can be improved the situation. I think we haven't got to underestimate, and we all need to push at our MPs and things when we see them or when we're protesting or whatever you like to call it. We haven't got a crystal ball, and it's the people that pass away within the 7 years that you can't plan for. Well, you can plan for them, but you can't do it. And it really frustrates me that this is a tax on unplanned deaths. But you can see that with a fair wind and a bit of health luck, you can plan and mitigate against it quite successfully as long as you survive 7 years. So that's inheritance tax in a nutshell. Capital gains tax was changed. You might all, or there might be farmers say, I'll not pay inheritance tax on my farm, I'm going to sell it and spend the money or do whatever. So just remember that the rates are going up. Business asset disposal relief rates is going up, and it's only available if you sell the whole or substantial part of a farm. So business asset disposal relief isn't available if you just sell a couple of fields. Tax on the sale of houses and cottages, anything residential, is payable in 60 days. Just some little pointers to bear in mind. So I suppose that, as well as this webinar being about inheritance tax, clearly it is, it's about succession. And I've put this slide on just to give you the pros and cons of giving assets away now or holding on to. And this slide is, the inheritance tax proposals have changed this massively. Because if you hold on to assets, you are highly likely now, unless you've got a very small block of land, to leave a fairly chunky inheritance tax liability around. But there is some advantages that you are in control of your own income. You haven't got to give it down to son or daughter who then goes and gets divorced. I'm a firm believer that you are holding back the next generation. But I think financially now, the potential inheritance tax risk just top trumps all the other reasons or all the other pros of holding on to assets. So now I think it is give assets away at the right point in your life when it's right for your family. It does mean that you will have to have a conversation about where your income's going to come from, and can you give all the assets away and take no income or not. It does have those risks of divorce and things, but there's ways and means of protecting that. And I'm a great believer in some of the most driven farmers and things in the country that I bump into are the ones that do get some of the rains earlier and are incentivized. So I think if you're trying to look for positives in a gloomy cloud of a budget, this will force family farms to do the succession earlier, which isn't an easy conversation, but I think it has its benefits once it's done. And assets will be looked to be moved around. So what should you do now? Actions, I'm finished now, you'll be glad to hear, but your actions now, don't rush into anything. Understand who owns all the assets legally. Are they partnership assets? Are they individual owned assets? Prepare an estimate of your asset values. Get a copy of your existing partnership agreement if you have one. Get copies of existing wills if you have one. and and one line I didn't put on here: have some family conversations. Obviously, inheritance tax planning is usually about the elder generation, but the planning is going to involve the younger generation. So have some open and honest conversations. Don't assume you know what your children want out of it all. Have those conversations and effectively be ready to take action on mitigating your inheritance tax position when we know the details. And I think that's where I'll stop for now. It does say any questions, but as Adam's kindly said, we'll do them all at the end, the three of us that are presenting with at the end. So I will stop sharing and let my fellow panelists, Tom and Sam, crack on.
Okay, thank you very much, Andrew. That was absolutely brilliant. Presented in a very straightforward way, which somebody like me needs. But thank you for just touching on the end there. That's the cracking bit, because I know these guys are going to come on to this now. It has always been the elephant in the room, and in some cases it's never been necessary to talk about it. Right now, I know from personal experience there are a lot of farming families having to sit down and have these conversations, and there are people out there who can help with that as well as we can help you with as you go forward. But for now, I'm going to hand over to the Sintons guys, to Tom and Sam, and they're going to talk a bit more about succession and a rake of other legal stuff. So over to you guys.
Thanks, Adam. We're just going to make sure our presentation's on the screen. Thank you all for joining us this evening. And apologies in advance for the pun on the screen, succeeding in succession. My name's Tom Wills. I head up the Rural Services team at Sinton's. This is my colleague, Sam Watts, who's sitting to my right, your left.
Hi, guys.
I must say we look a bit younger on those pictures. So that's a little bit of a while ago they were taken. In terms of the team at Sinton's, for those of you who don't know, we're a full service practice. We specialise in agricultural work alongside other things. We have probate, solicitors, wills, trusts, litigation. We do specialise in partnership agreements and wills as well as agricultural property. So thank you for the plug, Andrew. It is a necessity, I think, that everybody has all of their paperwork in place. So we thought we've also been party to a number of these types of presentations. Obviously, it's very topical what is happening at the moment after the budget. And I think we see this, and just to echo what Andrew says, is make sure you get yourself all of the information so that you're armed with that key knowledge to make the right decisions. Andrew has quite rightly said that the devil is not in the detail yet. This is not into law at this point in time. We've all been given, I think, a bit of a shock by the budget when that briefcase came out. But we do need to make sure we don't make knee-jerk reactions to things. I appreciate that a lot of people think the clock is ticking. Obviously, the 7-year rule is something that's going to be pertinent to many people, but we do need to make sure we know what we're doing. These decisions are permanent ones, a lot of them. We're talking about giving away land and assets, which are not easily changed, if at all, possibly changed. So they're permanent decisions. Make sure you've got the right information. You're armed with that information to make the right decision, even if that decision is not to do anything. Please don't not do anything through inertia. Do it because it's a decision not to do anything. Andrew touched upon wills. I was quite pleased to see that. There are two kind of key ways that we looked at this. There's death planning, so planning on death, and that's when your succession will kick in, or there's lifetime planning. And typically in the industry, I hear a lot of people saying in the media that the average age of a farmer is too old, which I think is unfair. It discredits the individual and the industry as a whole. But at the same time, I think that's an unfair statement, because the whole system is essentially set up to allow farmers to continue to farm. And sometimes that's propped up because of the system and the tax system, which has been changed significantly by that budget. So at the moment, obviously, Andrew has mentioned these things. Why would you not continue to farm and pass your assets on death? You get rebasing for capital gains tax purposes. And of course, you get APR and potentially BPR on the majority of those assets. So it's a big kind of shock to the system in terms of how people will look at distributing assets and succession. And it will hopefully promote a lot of those discussions that need to be had within the family. I think one thing that we touched upon, and please do make sure you have a will in place. We can obviously help with that. Other people will. It is shocking how many people don't. So even if you do lifetime planning that I'm going to come on to for succession, you still need a will. Everybody should have a will. It's essential, alongside powers of attorney in case anything happens in the interim that make you unable to carry out those decisions that operate and are key for your business. So please do make sure you've still got a will in place. And I think, if you do lifetime planning, which we're going to come on to talk about, you're not necessarily chained to the will of Parliament. If you're waiting to pass your assets by your will, you've always got that risk element that, the law will change, as we've potentially seen with the budget. So you can never guarantee what anybody is going to do, but actually if you take active steps within the legislation, that gives you the best methodology to try and avoid future risk. So yeah, please try and avoid being chained to the will of Parliament, so to speak. So lifetime planning, and I think we're going to see more of this. Andrew's obviously touched upon a few elements. Basically doing things during your life, encouraging those succession conversations early, making those transfers of assets, and basically, as Andrew mentioned as well, make sure you understand all of the structures that you have in place. Who owns the land? Are you farming in partnership? Have you got a limited company? Who owns the assets? Is it are they on the balance sheet, for example? Is that land on the balance sheet? Who owns it? So make sure you're armed with that information to make the early decisions in advance. So lifetime planning is probably a bit more about being proactive rather than reactive. And we're going to be looking more and more at pets. I'm not talking about Turner and Hooch sitting on the side of the screen there, or Bonnie and Clyde, or whoever you like. I'm talking about potentially exempt transfers. That's potentially exempt transfers from inheritance tax purposes, i.e. making a gift, giving it away, essentially, as simple as that, giving it away and surviving the 7-year time period that Andrew referred to, which then takes it out of your estate for inheritance tax purposes. So that's pets. We're going to be talking a bit about those, but it's just basically giving the land away or giving gifts or assets away. Trusts as well. Trusts are an option. So a number of people have looked at these and will look to continue to do so. It's not necessarily giving full control away to the beneficiaries. It's putting people in place to make decisions on behalf of assets, but trying to safeguard those assets going forward. Obviously, there are administrative charges relating to that, and there can be other tax charges. And we would always say, speak to Andrew, his team, and all of your professional advisors together before doing so. Also, maybe they're a potentially risky thing at the moment, depending upon how we've seen tax planning go and the government policy. Maybe there's a route for them to attack those structures going forward. But as you say, the devil's going to be in the detail going forward about things.
Right, I'm not going to give myself too much of an introduction, as Adam had very nicely done that at the start of the presentation. So this is the question that you'll all be asking each other, asking yourselves, and asking us what to do. And I think Andrew hit this very, very nicely, and Tom's also touched on it. Probably in terms of taking irreversible or even major steps, nothing at the moment. But you want to put yourself in a good position so that you can carry out your succession plan when the detail is announced. So I think the first question you want to be asking yourself really is, what do I want to do with my land? And this should be something that you're all really considering and talking to each other about before the budget announcement. And I don't think these conversations have really happened enough. So one real positive to come out of the budget is that people are going to be having these conversations, and your estates and your affairs should be in better order. But for that, So yeah, think about what you'd like to do yourself, you know, who do you want the land to go to and that sort of thing. And then have a chat with your professional advisors about that. And what we can do is, we won't tell you what to do with your land. Of course we won't, because it's your land, but we can discuss with you ideas that you've got, as can your tax advisors, as can your accountants, and decipher whether or not they sound viable, or whether there are real issues with your plans, or what sort of tax implications will be connected to your plan. So I've put a few different advisors, professional advisors up there on the screen in terms of different professions. You know, you've got your tax advisors, you've got your accountants, your solicitors, you know, which is what we do. Your banks as well are very important, because you might have funding to a bank, you might have charges on properties that needs to be considered before succession. Land agents, you'll know yourselves, you know, your land agent often knows as much about your land as you do. And I think, and I'm not saying that to discredit any of you at all, but I think the point is that land agents are worth the weight in gold, really. So have a chat with them about your potential plans. And also, one thing I wanted to cover is that we, in the rural professional sector in the northeast, in Cumbria and beyond, we all know each other, and we've all got mutual clients, and we like working together. So get us all around the table and let's have a chat about your plans and what you'd like to do with your land, and that's probably fruition. But I would underline that with the point that Andrew and Tom have already made, in that let's not make rash decisions now, but let's have conversations about decisions you'd like to make. And when the detail comes out, we're in a position to enact those plans. A very, very important point I've put at the bottom of the slide, and Andrew did touch on this at the end of his presentation, and this is the kind of thing we'd like to encourage amongst our community, is have conversations now with your potential beneficiaries, or with the people you want to make gifts to. We often see, particularly with, you know, some of the contentious probate work our team does, and the death planning work our team does, we often see dad wants to pass the property to son, pass the farm to son. Dad dies, he passes it to son. Son wants nothing to do with it. He doesn't want to farm the land. The estate's sold, which is, you know, it might have been that daughter would like to farm the land. So have these conversations with whoever it is you need to have them with, in terms of your beneficiaries, your family, your children, to make sure that your plan also works for those. This is more of a practical point really than a legal point, but it's a very important point. Try and be open and have these sorts of conversations with the people that will be affected, because it might be that your plan actually doesn't work for the person who you thought it might. And that's a really important point.
I think that is critical, isn't it? I mean, I know I've been around table meetings with Andrew where we've had scenarios where, you know, you're talking through a point, you're giving advice, and then the lawyer will come in or the accountant will come in with a piece of information and say, well, actually, we need to think about stamp duty in terms of that, or we need to think about how that impacts, you know, is there a reservation of benefit in respect of that? So it's getting people singing together, talking together, and getting advice from all of the professionals, so the plan works for everybody, and you're not kind of hitting any snags later down the line.
I think also, Tom, is that probably there's a lot of things that Andrew would think about, for example, that we wouldn't, you know, from an accountancy perspective. So it's involving people who look at things in different ways to make sure that you've got all of the right advice and you know all of the risk involved with your succession plan.
100%. So guys, some of the things that are possibly going to impact you either being able to enact a succession plan. So it's about getting researched up, it's about getting the information, it's about understanding things in advance so you're ready to go when we know the detail, when you've got a plan. One of those is obviously tax. I touched upon stamp duty, land tax there, sometimes we've just forgotten about. But also we've talked about, Andrew's gone over all the taxes, but inheritance tax is critically probably why we're all here listening to this talk today. You know, Farmer Harmer Starmer, as everybody is talking about, which is, yeah, he's put everyone in a position where they need to act. So have those critical conversations. Business structures, understand how your business works. I'm sure you will already, but Andrew touched upon, as Sam will probably talk about, who owns the asset. Is it, you know, we see lots of farming businesses or estates, and they are not simple in terms of ownership. Some people farm individually, lots are in partnerships, some are in a hybrid of that with companies, and all sorts of arrangements. So make sure we know where everything is, if we are going to put a plan in place. Family relationships can get quite tricky. You know, it's human nature, but I've been in many meetings with clients, and they've said, look, I want to go through a succession plan, but I have concerns about my son and him getting married in the future, or an existing spouse, or his wife, or their wife, or what happens with those parties. That's human nature to understand that, and you never quite know the answer. So it's bearing those decisions in mind. Do you put different steps in place, potentially such as post-nuptial agreements, pre-nuptial agreements? You know, you can't always circumvent everything, but you can do certain types of planning. Also, you know, you may own the land with a brother or a parent, and it's how do you then work out who's going to succeed, who's next? Is it your children? Is it their children? Is it nobody? Is there a successor? It's understanding how those play out and all the different family ramifications. So, which is why it's important to have those early discussions. What's the current position financially? And again, something Andrew will always help you with and tell you about. Is there existing debt? Will that prevent a potential succession plan or an early gifting of land? Is there an existing charge on that property or over the business? Is the bank going to be happy that that is transferred? You know, try and get your bank on board if there is lending there, as typically there often is, because that could be a bit of a stumbling block. And if it is something there, get it planned in advance, have those early conversations. It doesn't have to be anything concrete, but just say we're thinking about doing X. Just have those discussions. Andrew's touched upon reservations of benefit. The most obvious one is, you know, giving away farmhouse and continuing to live in it. Clearly, there's a reservation of benefit because you're continuing to stay there. What you don't want to do is to do that, live 7 years, think that's outside of your estate, and it get clawed back. Make sure you've got the right documentation in place, because that can protect you. So if you had a tenancy back, say for example from the successor, allowing you to live in that farmhouse, and you'd paid a market rent, I know that's going to sting because you've given away the asset, but it's that evidence base for HMRC, if called upon, that you can look at kind of sorting out. Andrew touched upon partnerships there, and partners not reserving benefits as well. So that is also something to bear in mind. But this is why the advice is critical. Don't want to go into too much detail today about things. Land can be split. So we're talking about big assets. There may be more than one successor, maybe multiple children. It may be different siblings as children. So how is that land being split? Who's getting the asset? Oh, I nearly missed a bit. So that bit, which beneficiary backing a horse? I'm not talking about going down to the local bookies or going on a Paddy Power app or anything here. What I'm getting at is, if a lot of clients have been coming to me saying, I must get this in joint names between husband and wife, and then we're going to look at gifting to children. This is a tricky one, and maybe Andrew might give a view after the presentation, but I think under current rules, my understanding is that the people who make the gift, and if that's more than one person, both need to survive 7 years. And if one of them goes, then essentially that part could be clawed back into the estate. So it's almost who's the best bet to leave that land with before you gift it, which is an awful thing to think about with human nature, and life is very fragile in a way. So people shouldn't really have to make these kind of decisions, but these are things that people have to think about now, or potentially may need to when we see the detail on that on this legislation. Another concern is obviously of government and policy. Hey, that's why we're here. What are they going to do next? And whether that's a blue, red, or yellow government, the last one's probably unlikely, I appreciate, then they're all going to make decisions that affect us all in our businesses. And losing control, that is a big decision in all of this, because some people will say, but I don't want succession yet. I want to keep going, I want to keep doing this, but in a way it's been forced upon people. But I think if that's the way you arm yourself with the information, decide that's what you want to do, make sure you've got your will in place, make sure you've taken all the steps possible to make it the best possible route. And Andrew's touched upon life insurance as well, which I think is definitely going to see a boom, isn't it? Definitely.
Right. Andrew, you got there first with my catchphrase, get your ducks in a row. But I do have a lovely photo of ducks in a row, so I think I can take that one. I think my slides are a little bit more positive than Tom's. Now, obviously, we designed the presentation together. Tom spoke about the concerns and the issues and that sort of thing, and we're hoping that you go away from this presentation with a few positives and things to think about, and steps that you can take pre-detail being announced to put yourselves in a better position to then put your succession plan in place. I mean, the best piece of advice, or the most useful piece of advice we could give you, is to survive 7 years. Now, that's obviously not a practical piece of advice at all. And that's kind of the key number here, isn't it? Andrew spoke a lot about the 7-year rule. Tom's mentioned it too. And that really is the key number. Unfortunately, we can't plan that way, can we? We can't plan to survive for an extra 7 years. So it's obviously a bit of a silly piece of advice, that. But really, some proper practical tips. Now, we're looking at this from a property perspective, and things that you might stumble across that actually might scupper your succession plan. So it's good to be able to think about these things now, so that when the detail comes out and we want to put plans into place and make transfers and make gifts and incorporate a trust and that sort of thing, we've already considered these things, and these things aren't going to stop you doing what you'd like to do. First thing I've got on there is charges. Speak to your banks. I've mentioned banks. Tom's mentioned funding and lending. This is really important. I mean, a lot of pieces of land will be subject to bank charges, which you'll probably all know, but just to dumb it down a bit, your bank might have a charge on your farm, and you might be obliged to pay them a certain amount of money per month. And if you don't do that, they might be able to repossess your farm. It might be that you've got a charge on your farm that was put in place in the 1980s that you've actually paid off, but it's still on you. The charge is still on your farm because steps haven't been taken through land registry to release that charge. That very often happens, and it can be quite painful speaking to your bank a week before completion of your succession plan or your gift to get that charge released, because they might have lost the papers if it was that long ago, that sort of thing. So we will be able to help you with your title register and see whether there's a bank charge on your farm and that sort of thing. It might be that you haven't discharged the debt on your farm, and if you do plan to pass that to son or daughter, whoever it is, it might be that your bank would like to join them into the loan as a borrower, which will obviously be a liability to your kids or whoever your beneficiary is going to be. So this sort of thing it's really important. Have a think about it. Involve your bank in succession plans if there is a charge on your property, so they know what you're doing and they're happy with you doing that. Because bank charges on farms and land is something that can really scupper things. So yeah, that's spoken about. Tax advice, obviously, speak to your taxation advisors. Now, I don't think it's, and Andrew might tell me otherwise, I don't think it's premature to be speaking to accountants or taxation advisors now with regards to what you'd like to do. It's probably premature for us to tell you what you should do or what we think the risks are and that sort of thing. As Andrew and Tom rightly pointed out, the detail has not yet been announced. But that doesn't stop us from having a conversation with you now as to what you'd like to do, and with a view to then putting that in place and providing some more solidified advice when the detail comes out. So yeah, please do speak to people about this, particularly your professional advisors. The last thing I want to talk about, and it's multifold, this is your title to your property. Now, I think particularly our sector, the rural sector, are probably a little bit poor in knowing exactly what's going on with the land, who owns it, what sort of things are affecting it, and that sort of thing. And that might be because it hasn't changed hands in a long time. Whereas with residential property, commercial property, you'd probably see that moving hands a bit more often. So you're dealing with these issues a little bit more often. Now, the things we would quite, and I say I'd quite like you to look at, it would really be our job to advise you on these things, but just be thinking about them now. Make sure you understand if there are any restrictive covenants on your property. Now, they might not be an issue, but it might be that you have a restrictive covenant on your property that would, let's say you want to pass property to son and he's going to slightly change the farming operation, and it might be that there's a covenant on the property that might stop him from doing that. You don't want son to find out about that after you die and he gets the property, or even after the gift's been made. So have a look at your titles, or ask your solicitor to have a look at your title registers and your deeds and that sort of thing, so you can understand what encumbrances are affecting the property. So that's quite important. Restrictions. Now, there's a restrictive covenants and restrictions are sometimes, the terminology is sometimes used interchangeably, and that's not technically correct. So a restriction will be a note on your title register that will tell land registry that they can't do anything with your property until something's been satisfied. So we spoke about bank charges. Pretty much all banks that have a charge on your property will also have a restriction on it, which will say you can't make a disposal of the property without your bank's consent. Now, that's obviously a big problem if you want to put your succession plan into action, because you're going to need the bank's consent. Now, I've already spoke about banks, but you can have restrictions in favour of individuals, third parties. It might be that your brother lent you some money 20 years ago to buy the farm and he's got a restriction on your title. It might be that you fell out with your brother, so you need his consent to pass it to your son. Have a think about these things. Another key restriction that you'll find on properties is restrictions protecting overage. So it might be that you bought a piece of land and the person who sold it to you has overage on the property, which is sometimes known as clawback. So it might be that if you develop it, you know, put residential properties on it, the person who previously owned your land gets 20% of the uplift in value or something like that. Now, that's quite important because you're going to need their consent to sell it. So it's really, really key understanding the title to your property before you put these plans into action, because it could affect what your plan is. So that's really important. Ownership structures. You probably now feel like we've been banging the drum a lot about ownership because it's very important. I think particularly in our sector as well, we see this quite often. We'll get, you know, good farming clients of ours who we've been advising for years and years will say to us, I own this farm, I want to pass it to my son. It might be that you do a bit of work on it, you finally look at the title register and it's owned by the farming company and the majority shareholder is dad's brother. Now that's a problem because he's going to have to agree to whatever you want to do with the property. It might be that you own it 50-50 with your wife, so your wife needs to consent to what's happening with it, and she might have a different idea than what you do. It might be, you know, there's all sorts of different types of ownership structures, and it's important to understand that you know exactly who owns your property. Is it the way you think it's owned? It might be that there's a partnership deed sitting in the background that says the property is owned 30 by partner 1 and 70 by partner 2. That's really important. It would be good if you had a partnership deed in place. I think Andrew's mentioned that, so that would be a good start there. It might be that there's a declaration of trust sat behind the title, which says that, you know, actually mother is legal owner, but beneficial owner is son and daughter. So really the equity is already with son and daughter. So these are important things that we'd like to review before you put your succession plan in order.
I think that's a good point, isn't it? That those are things that we can, if you sat there in any doubt about these things, or you just want to do a double check, those are the kind of things we can look at for you, help you with, and give you a steer on. I think it's all about getting the right information so you're ready to make that call when this further information comes out, to assess all of the information and then ultimately come up with a decision that's right for you, whether that's to do something or not do something. At least you've armed yourself with that right information, haven't you? Exactly,
yeah, that's exactly the point. Another thing I wanted to cover was title boundaries. Again, more often than not, when we're asked to sell a parcel of land, you might get land agent or landowner coming to you with a plan of the land to own, and, you know, I want to sell this to party B, or they want to pass it to the son, and we then look at land registry and the title plan's completely different to the plan that farmer thinks it should be. That's often the case. You know, how often, because agricultural land often stays in the family and might not have changed hands during your generation, you might not have actually seen the real boundaries of your land. So if there's a discrepancy between what land registry think you own and what you think you own, we need to know about that now, because these sorts of things can take a while to get sorted at land registry. Land registry are quite typically, and sorry if we've got any land reg employees on the call, I'm not slagging them off at all, but they have so many applications to process that it can often take years to get applications through at land reg, particularly if they're quite complex. So if there's a title plan discrepancy, you need to know about that as soon as possible so you can kind of rectify that. It might be that you're farming a field next to your farmhouse and actually that field's unregistered. You'll need to then try and go through a process of first registration before you pass that to beneficiary. So that's another really important point. And more often than not, in that large scale agricultural transactions, these sorts of issues come up. So it's good getting your ducks in a row, that sort of thing now, I think, is the point. The last point I wanted to speak about with regards to title, and again, this feeds quite nicely from some of the points Andrew and Tom made, is that if you have multiple beneficiaries, you own a large landholding, it doesn't have to be large. It could be a field and a house. It might be that you want to pass house to son and field to daughter. You'll need plans to show those sorts of things, so it might be worth getting those drawn up early doors. But also you might need to think about, if son lives in the house and daughter lives in the farm, and daughter farms the field behind the house, how's she going to get to the field? Do we need to put easements in place to document that? Those sorts of things can be drafted and almost agreed in advance. These sorts of things often cause difficulties, so it's good to try and get those in order early doors. I think that's pretty much in terms of also another piece of advice would be make sure you have a will and a partnership agreement in place. And I think we've been banging the drum on that for years. And I think now really you're going to be forced to do that sort of thing rather than us saying it's a bit of a necessity. You're really going to need to get that in place now. And again, we'll be more than happy to help you with that sort of work.
Thanks, Sam. Yeah, so there's the farmer's friend at the bottom of the screen who's banging away, and that's for us all, which is good. Probably a bit of a picture from a prior life, but I think the main thing, kind of to end on a bit of a positive, is to try and stay positive. Things that governments change policy all the time. The government's only in power for a maximum of 5 years before they are put back to the public, and decisions are permanent. So make sure you've got that right information. And you've got the key knowledge to make that. Don't do anything too knee-jerk. And you never know, there might be some concessions made to this, whether it be straight away, whether they've listened a little bit and maybe some of the detail isn't as bad.
Quite wishful thinking, that, isn't it? But who knows?
I think it is, because they're not going to want to lose face, certainly initially, but I do hope that they have listened to a lot of the outcry that has been there. But make sure you've got all of the information you need to make those right decisions. If you are planning on a succession policy and a plan, that you've gone through those steps and you're armed with that information. It's not going to be something that then scuppers it, like one of those restrictions on title, or you've got your people to look at things in advance. I think that's really quite important. We can help you with all of these things. Ask an Andrew, and really we'd be happy to take questions. We've given a bit of a whistle-stop tour about some of the options there, but we'd be very happy to field questions, and we're certainly hopeful there's going to be some.
Right, I will stop sharing my screen and hand back over to Adam and Helen.
You may be muted.
Adam, I think you might be muted.
How long have we been doing these meetings? There's always one. Never mind. I was saying thank you very much for you three guys for that whistle-stop tour. Even in that sort of broad brush grassroots approach, which we love in the Farmer Network, there's a lot of information. And just to remind everybody that we can email to you the presentations in some format or another, so that we'll make sure you get that information. Now I'm going to hand over to Helen, because I think we've got some anonymous questions in the Q&A. Helen?
Yeah, we've got 3 questions that have come through, so I'll just read them out. They will be anonymous, so don't worry for those who've asked the questions. I won't say who you are. So the first one, if my father, who owns half of the farm, now suffers from vascular dementia and is unable to make any decisions, and the children who are power of attorney but are also the beneficiaries of the will, what can they do?
Probably probably a legal question. I think just to duck out of that
Yeah.
one. But my
Yeah, I think it is, Andrew. You know, go on. Sorry, did you want to
Well,
chime
yeah,
in first?
I have a client in this exact situation, and we've concluded that there isn't anything that can be done to change the will, because the will's supposed to be, and as far as I'm aware, a personal decision. Powers of attorney can't change the will or where the assets are going. So I think it's, unfortunately, sit tight and hold tight in that situation. But the two lads might have a different view on that.
Yeah, I mean, it's obviously an awful situation. I mean, the first thing I was going to say is there a power of attorney in place? And I suppose, thank God, there's a power of attorney in place at all. It's definitely a tricky question, and it's certainly something that some of my colleagues would be better placed than myself to answer. However, look at possibilities about varying the will, perhaps. Whether that is fully achievable within the powers of the attorneyship is a different question, and probably needs a specific head on it with more experience of those specific will matters than myself. But varying a will is possible, and that might be a potential route. But I would caveat that to say get some specialist advice. But we do have colleagues here who could help you with that aspect if it's something you wanted to get in touch with us afterwards, as most firms would be able to help you with. But yeah. Do take some advice on that, because that might be something, but that's obviously a post death variation typically.
Thank you. Second one, can you borrow money against a trust?
Yes. Yes, based on similar criteria or similar banking criteria to borrow it in a business name, but it's always more complex where you've got trustees running the trust that have to make the decisions and be comfortable. And I think it's, yes, you can borrow money in the trust just like you would in a business, but it's a lot more complicated, and banks are a lot more resistant or reluctant or slow or don't want to do it, might be the thing. But yes, you can, but it's not easy.
I think we'd probably say something similar, wouldn't we? In that we don't see it anywhere near as often as you do with an individual or a company borrowing. Not sure if you were going to add anything, Tom.
I mean, I suppose every trust, when it's set up, has a set of rules, so to speak. So the governing document of the trust, the trustees therefore can operate within the parameters of that trust, and it gives them powers to do certain things. So one of those would specifically be how are they able to deal with land, and if it says they can't charge land, then or charge or borrow money, then they can't. But typically that would be probably unusual. But I think that's probably first port of call. You're quite right, Andrew. Banks don't like it at all, and I believe that's largely because they struggle to get up through their systems these days with all the new kind of how do you trace all the individual owners, and I think they've got new criteria of all of that, which I think is quite tricky. It's not impossible. I have known it.
We're actually doing one at the moment, Tom. So we've got one which Tom's aware of because he's supervising me on it. And what I'd say about that is that it's been not on our desk for a long time. We've been working on it for a long time, but there is just so much work to do. So I think the job we've got on at the moment, there's a change of trustee. And that simply there's a change of one trustee in the trust. It's got lending against a lot of property, and it's took that long because there's so much, a lot of paperwork to go through, a lot of legal due diligence to go through, just because there's one more trustee coming into the trust. And yeah, so banks probably will be a lot more cautious lending to those sorts of entities. I mean, it's the matter I'm thinking about is it's took a lot longer than it should, hasn't it? And that's because of the reasons we've just set out, really. But that also shows you that it happens,
I think the context of the question is important. If the question is in the context of, I'm thinking about putting land into trust as a succession plan and then raising money, I would think try and work out what's most important, because that might be quite a convoluted, tricky thing to do. Obviously, every circumstance is different, and every situation is subjective, but it's certainly not as easy as it would be in if it wasn't in a trust, for example. Hopefully that answers the question.
Thank you very much.
Okay,
It doesn't sound easy.
No.
Have we made that clear, Adam?
Third question. Please could I ask about the 1 million APR plus BPR allowance per individual? Is there a limit to this? For example, if there are 4 joint owners of the farm business, will the allowance total 4 million or is it capped at 2 million? And to clarify, any one of the joint owners will lose their allowance on death.
I probably led us all into that one. So no, the limit is 1 million per person. So in the example you've just quoted in the question, if there's 4 people jointly own the farm and it's worth 4 million, each of them will get 1 million towards it. The 2 million cap is obviously been heavily quoted. That's in the government's typical husband and wife ownership scenario. And anyone that doesn't use their million, it doesn't go to anyone else. So if you die with no assets because you've given them all away, or you don't own any because they're still in the elder generation, your million just disappears. So it's not transferable. But if there's, I think a better example, because farms aren't often owned by more than 4, but if you've got a company, because remember that businesses have been hammered by this as well as just farmers. If you've got a company that's worth 10 million and it's got 10 equal shareholders at 10%, they'll each get the million as well, all 10 of them, as long as it's structured right. So it's 1 million per person essentially, and the more owners you've got, the more millions you've got.
Yeah, I don't think we really need to add anything to that, to be honest, Tom, would you?
I think we're in danger of giving tax advice, which we can't do.
Thanks, Andrew.
Very clear, Andrew.
Okay.
Thank you. Go on, Helen.
Next one. Does there need to be consideration of future liabilities of a farm business before passing it over? For example, buildings that might require serious remediation.
That's a good question. I'm sure the other. Yeah, I think you've always got to consider. I'm not sure. I've never really thought about it for future liabilities on properties, but I think there is something. If you have a block of land that may go for development or may increase in value in the future because it's neighbours the village, or it's going to get the city bypass on it or whatever, I think there's that sort of land should be moved on when it's still just farm value rather than development value, because obviously the important on the 7-year rule and inheritance tax, the important thing is the value it was worth on the day it was gifted, not on the day somebody dies. So if you gift a nice block of farmland on day 1, it's agricultural value. 5 years later, it gets planning permission for houses, it suddenly changed value totally. But as long as it's still been used for farming, if somebody dies on the 6th year, the inheritance tax is worked out on its value 6 years ago. So it doesn't quite answer the question about future liabilities, but I think future liabilities and gains and increases in value should be considered before passing land over.
Thank you. Well, Helen.
Yep, I'm the son on the farm now, running in partnership with my dad, but he still owns most of it. Is there anything stopping me buying the farm from my dad for £1 rather than gifting it to me? Are you just taxed on the sale value or the market value of any asset?
Well, I think that one they're all tax questions. Can we have some legal questions?
Glad you said that.
That one's caught and always had been, unfortunate. It's a great idea. I'll buy it for £1 and whatever. But any transactions between connected parties, so any transactions between connected parties for tax purposes, are deemed to have happened at open market value. So if you can give your dad £1 for the farm, and Tom and Sam could transfer the title deeds over. But for the taxman's and it would be legal, the son would then own the farm legally, but for tax purposes, they would say, well, what's the farm really worth? And we're going to tax you on that. But remember that you can move farmland around tax-free, even though it's at market value, because we've got holdover relief for capital gains tax. But no, it's a nice try. Somebody was trying to, and I'll be interested, just whilst we've got two legal experts, somebody was trying to suggest to me that they should put a 100-year lease on their farm to devalue it. And I wondered how, I still think they'll get round it, but.
Yeah.
I've heard a lot of people talking about this. I've heard a lot of people talking about taking additional borrowing as well as a result to, you know, if I've got borrowing against the asset, it's essentially worth less from that perspective and getting rid of the cash. But I think it's like anything, like you were saying, I think it's a good idea because yes, if there's a 100-year lease on there or a certain tenancies in place, it potentially means that asset is worth less when it's passed. Makes a lot of sense, but I think you've got to make sure that, you know, it could be looked at, couldn't it, if that is something that is done and it's done deliberately to devalue that asset for that transaction. That's something that the revenue have fairly wide powers for, probably strangling into your territory, Andrew, but they have fairly wide powers to unpick transactions, don't they, that they think have been done for said purposes. So I think just be a little bit careful. I mean, if something is being done in the general course of your business, which happens to devalue it, then, you know, question why you're doing it to devalue. But if it's for another purpose, then, you know, that might work. But just be mindful that anything you do with a certain hat on can be looked at, and obviously that's not something that's encouraged. So yeah, just I think tread a bit carefully.
I think that might lead on to the last question, Helen.
Yeah, we've got two more. Who is going to value your farm on probate?
I think you might have answered that one, but go again.
Yeah, somebody. So it needs to be at market value, and somebody will need to value it that has the capabilities of understanding it and farming it. So it's going to be land agents, and then if the plant machinery was to value and the livestock, it's going to be, you know, specialist auctioneers or valuers of that needs to do it. And then we will use those values to put in the accounts to value the business as a whole, you might say. But yeah, it's the specialist valuers.
Typically,
it's not a finger in the air sort of job. I think it's probably the point, isn't it? It's, you know, you'll have a chartered surveyor probably will see you.
Yeah.
It's a red book, Andrew, is it? Or
I would. It needs to be real. As I said before, I think in the good old days where we're still at temporarily at the moment, HMRC were particularly interested in the estates of, you know, normal standard run-of-the-mill farms that were big farming operations without other income. They're going to be massively interested now, because if you've put a finger in the air and say, oh, it's worth 2 million, husband and wife, 2 million covers it, and it's really 3 million, they're gonna come shouting along the line saying, oh, you valued it wrong. There's tax at stake now, so it's going to make them far more interested.
Absolutely.
It is going to have to be done properly.
Yeah, absolutely. And as you rightly said, it's usually a red book valuation under the Royal Institution of Chartered Surveyors, and those values have to be right because the taxman will come looking if they're not. So it's something which has to be done right. Okay, I think we've got time for two more, Helen.
Environment schemes. If there is private finance opportunities on the land, e.g. BNG, is this taken into account in the valuation of land?
That's a very good question, isn't it? It's a bit of a new beast, this, even with regards to how a BNG unit is valued, I think. I don't know the answer to that, Tom, do you?
Well, I think it probably depends. Andrew will have a view as well. I think it probably depends on how is that BNG articulated, essentially. Is it a lease to somebody? Is it, you know, in some ways, it may be something you've already derived some value from, and it may actually devalue the land for that purpose because you've already got the money in the business.
Yeah.
But it depends how that really is set out legally and is documented? I would probably say, Andrew, do you think?
Yeah, I totally agree. I think it depends on what the future incomes. I'm not a valuer, but it's going to in my view, depend on the income stream that is or isn't going to come on that land. So I've only there's what I know of. We act for a client with the B&G that's now being sold in units, so he's getting a lump of money up front on each unit, and then that's all he ever gets. He has to maintain the field. So actually, every time his field's getting worth less as he sells them. And I think if it's those sort of situations, it will have an impact on the value, but I don't think the devil in the detail will be how it's valued.
Yeah.
Okay.
Right, last one. What do you do if a farm is owned by 3 family members who have to jointly agree on all big decisions, not to your children, if relationships are difficult?
So I think that question is saying that 3 people own the farm and one of them would like to gift their third to their children, isn't it? But it sadly isn't untypical of where farms are at. Obviously, it's probably more of a question. You can do what you want with your third, I think, if the title's drawn up in such a way, and get on with it. But I think probably need a legal mind, Tom, on that one. Can you give a third away if the other 2 parties don't agree?
It's
Depends how it's held, doesn't it?
yeah, it's probably grey, and we probably don't have enough information to answer it. We're talking about it's owned in a partnership, or we're talking about it's owned by 3 individually who will be used as a partnership.
I think in most cases, all 3 will, and it does depend how it's held. And are we looking at the legal interest or the beneficial interest? In most cases, you will generally need all 3 to agree, won't you? But there might be some situations where you can gift your beneficial third to somebody else. So there's a difference between legal ownership, which is what you'd see on your land registry title, and then beneficial ownership, which is what you might see on a trust declaration of trust or something. It might be that you can more easily gift your beneficial interest than you can your legal interest, because you'll need all 3 legal owners to consent to the transfer of the legal title. So it really does depend on how the property's held legally and beneficially, and what your trust deed says and what your partnership deed says and that sort of thing. But I think more often than not, you'll need all 3 parties agreeing.
It sounds like this might be kind of to make maybe a little bit of an assumption. If this were a partnership scenario where 3 are owning in partnership, and they either own it individually, in which case they can't just make a transfer of part of that to somebody else. They would all have to sign that transfer. Or you potentially, if it's a partnership asset, would have to look at how you extract yourself from the partnership potentially, or whether you can pass your share of a partnership on into the terms of that partnership agreement, perhaps. So I think it sounds as though this is one where maybe you might want to get in touch, and we can maybe look at a bit more detail with you and answer the question more appropriate for you, to be honest, because we probably need a little bit more information. But we're happy to do that if you want to get in touch.
But let's give you a bit of a steer, though.
That's great. Okay, it's nearly 8:25. I did say we'd try and keep it to the hour. We've gone a bit over that due to having some absolutely brilliant questions, and thank you for those. So we'll bring it to a close now. Just to summarise what I picked up from Andrew early on, his first big statement was know what you've got, and went into some detail about what that might be. And the next one was keep calm and start to plan. Copies of legal documents, covenants, restrictions, charges. There's a lot of work to do there. From Tom and Sam, they gave us 2 elements. There's the planning for death, the death planning, if you like, and there's also lifetime planning as well. What we do with the land. But in doing all of this, stay positive, no knee-jerk reactions, because some decisions are permanent. Both of them are saying absolutely and quite correctly, use all your advisors to make sure you don't leave any stone unturned. And strong message that I'm getting from many advisors now, and that is start the talking, get round the tables, get round the kitchen tables. It might be difficult, it might be awkward, but start those conversations, because in the long run, it will be the best thing that can be done if you haven't started this process in the past. So can I say a big thank you to our speakers, to Andrew, to Tom and to Sam, to my colleague Helen, working for us in the Northumberland network, and also to all of you guys who've joined our meeting today. Thank you. I hope you've got some benefit from it. And if you do have any other further questions, if you think about it, please do give them to us. We always say in the Farmer Network, we're a good first port of call. If you hear anything, see anything, you want more information, never be frightened to pick the phone up to the network. If we don't know the answer, we will know somebody who does. So on behalf of the network and our guests today, can I say a big thank you to you all, and have enjoyed the rest of your night. Thank you very much, ladies and gentlemen.
Thank you.
Evening.
Thanks, everybody.
Thanks.